Okay, hello everyone, and thank you for joining us for what small businesses need to know about the new tax rules with Experian, BBVA Compass, and Barbara Weltman. My name is Gary Stockton, and before we get started, I want to make sure that this session is as useful and as informative to our audience as possible, so please engage our panel using the question and answer applet you should see in the WebEx controls. I'm going to try and answer as many questions as we can near the end. Obviously, it's a very hot topic, so there should be quite a few questions. Those questions that we can't get answers, we will try and get answers back to you directly via email. And if you need a copy of the slides, we have put those up on the site. You can download those directly. There's a URL, bit.ly/tax-rules-2018. That'll give you a PDF that you can save for future reference. And I would like to tell you that today's presentation has been prepared by Barbara Weltman and BBVA Compass, and not by Experian. The information provided in this presentation does not take into account your particular circumstances, objectives, financial situation, or needs. Before acting on any information in the presentation, you should consider the appropriateness of the information for your situation in consultation with a professional advisor of your choosing. Experian does not endorse or approve and assumes no responsibility for the content, accuracy, or completeness of the information presented. Our presenters today are Barbara Weltman and Charles McCombs. Barbara Weltman is a prolific author with such titles as J.K. Lasser's Small Business Taxes and J.K. Lasser's Guide to Self-Employment, and a trusted advocate for small businesses and entrepreneurs. She's also the publisher of The Idea of the Day and Big Ideas for Small Business at www.barbaraweltman.com. She's been named one of the top 100 small business influencers in the U.S. 5 years in a row now. And you can follow Barbara on Twitter at Barbara Weltman. Charles McCombs is an EVP and National Sales Director for Business Banking at BBVA Compass, a 35-year banking veteran. He served in various capacities in the retail, private, and commercial bank. He started his career in North Carolina as a retail banker and served many positions throughout the state. In 2006, he moved to Alabama and joined BBVA Compass in 2008, serving as sales manager for the community banking segment. He's also served in a business development strategic role, working with the commercial, retail, and wealth bank to develop training, marketing, and sales strategies, as well as leading the emerging company segment. Charles is a graduate of Lenoir Rhine University and has been involved in numerous civic activities throughout his career. And now I would like to turn things over to Barbara. I'm going to pass the controls to you, Barbara, for the beginning of today's segment.
Well, thank you so much, Gary, and thanks to all of you for joining us today. I want to thank Experian for hosting this program, and I want to make clear at the outset that I'm not here to make you an expert in the new law, but to raise your awareness of some of the opportunities that exist for you and for your business. We're focusing on the Tax Cuts and Jobs Act of 2017, which made major revisions to a number of tax rules impacting individuals and businesses. The changes are historic and dramatic, as you'll see. Most of the changes begin in 2018, so they may not necessarily impact the 2017 returns that are being prepared at this time. So this is really for planning for 2018 and going forward. The changes, as I said, will impact your tax planning, your budgeting. They'll impact what you're going to pay on your profits, what you'll be able to write off on your investments in capital equipment, and I'm also going to touch on what hasn't changed, because I think oftentimes that's overlooked when we look at a new law. Many of the things that we're used to will remain the same, and I will point that out as we go along. And let me start off by focusing on, I think the key question for all of us is, what am I going to pay on my profits? Business has been booming for many companies, and we're seeing profits, and we want to know how much are we going to have to share with the government in terms of taxes. So when it comes to C corporations, regular corporations, the rules are pretty clear and pretty dramatic in terms of change. So we now have a 21% flat corporate tax rate. There's no more graduated rates as there used to be in the past. So a small business is going to be paying the same tax rate as a multinational corporation on its profits. But the 21% rate is certainly modest compared to where it was before. And it certainly helps U.S. businesses be more competitive in the world market. Another dramatic change for C corporations is the repeal of the corporate AMT. Now, we know that small businesses to date were exempt anyway, so for most of you listening today, this probably is kind of no matter, who cares? But now all C corporations can go forward without having to be concerned about the AMT. And what's interesting about the C corporation tax changes, these are permanent. But for most of you, I would venture to say, most of you who are listening are concerned with pass-throughs, meaning sole proprietorships, including independent contractors, S corporations, partnerships, limited liability companies, businesses where owners pay tax on their personal returns on their share of the profits. So what are the rules now? Well, while with C corporations it's easy to give a short answer, you're going to pay 21% of your profits. When it comes to pass-throughs, the answer is not so easy. So first you have to look at the tax rates for individuals, which have been reduced across the board. So we're now looking, we have the same 7 tax rates. There are still 7 tax rates, but they are reduced, 10%, 12%, 22%, 24%, 32%, 35%, and a high of 37%, which is lower than the 39.6% that applies on 2017 returns. So owners overall likely will see reduced tax rates on their personal returns. But on top of that, there's a brand new deduction. And I want to just spend a few moments focusing on this deduction because there's a lot of interest in it and there's a lot of confusion about it. So this is a new deduction of 20% of qualified business income. And this is not a business deduction. This deduction will not reduce the amount of your business profits. It won't reduce your self-employment income if you're self-employed. It doesn't even come off as adjusted gross income, as business owners are familiar when they deduct their personal retirement plan contributions or their health insurance premiums on their personal returns. Effectively, if you want to think about it, it's kind of like a standard deduction, meaning it comes off just before taxable income. But it will, if you're eligible for it, reduce the effective tax rate that you're paying on your profits. Because you're getting this write-off, you're going to really be paying a lower tax rate on your profits. And that's a good thing. Another good thing about this deduction is that it doesn't cost you anything. You don't need any outlay to claim it. If you want to write off travel expenses, you have to pay for an airline ticket. If you want to write off your office supplies, you have to buy copy paper. But here, you don't have to have any expenditure to get the deduction. You get it if you're eligible for it. And there are various rules and limitations on who can claim it and who cannot claim it. The key figures to note are, if you as the owner on your personal tax return, if your taxable income, this isn't your adjusted gross income, modified adjusted gross income, business income, it's your taxable income, and if it is below the numbers that you see on your screen, depending on whether you are married filing jointly or otherwise, you get the full deduction. 20% of your qualified business income, that's it. But once your taxable income crosses this threshold, there are various limitations. And I'm not going to go through them here. I have some information on your slides, but we have so much to cover. I just think one of the key points here to note is that we need guidance on this. There are many open questions about definitions and other matters related to this deduction, and we await IRS guidance. When that will be, nobody knows. The IRS is kind of busy right now dealing with the filing season as well as all the changes in the new law. So when we're going to get guidance, who can say? But moving on to another consideration that has changed in the new law is the ability to write off new equipment purchases. So if you're buying items to upgrade what you have, to add to what you have, machinery and equipment, the good news is, as a generalization, and I just want to make this as a generalization, you're going to be able to write off your cost all up front. Now, in the past, if you think about it, oftentimes you had to use depreciation, meaning that you wrote off the cost over a number of years. But now, with these new tax breaks, you're going to be able to write off most or all of the cost immediately up front. So, for example, for property placed in service this year, you're going to be able to deduct up to $1 million. So this means an awful lot of iPads for you to be able to write off immediately. There are, of course, limitations, one of which is total purchases for the year, which is noted on your screen. What hasn't changed about this particular deduction is you really have to be profitable to be able to use it, and that is what has been the rule all along. So again, if you're not profitable, if you're running at a loss, this won't benefit you this year. But I want to move on to the next item, or just explain further what will qualify for this Section 179 deduction. First, your expensing. It's referred to in various ways. So basically, it's for, as I said, the iPads, or it's things that you can touch if you want to think about it. But it's also been expanded to improvements in commercial property, such as roofs and heating and air conditioning, alarm systems, and to qualified improvement property, which means improvements to the interior of a commercial building other than elevators, escalators, or changes in the interior framework. So basically to existing buildings. This is brand new, the ability to use this $1 million write-off for these improvements to certain realty. Another way to write off the cost of improvements right up front is with bonus depreciation, which is also called an additional first-year expensing deduction. And so it gets confusing between these two separate rules in the tax law. But basically, both of them combine to help you be able to write off your investments. And that's really kind of the thought behind it, that Congress wants to incentivize businesses to make these improvements. Excuse me. So basically, whereas the previous deduction I talked about, you have to elect it, this is automatic unless you choose not to do it. And this is not a permanent option. This is a temporary option, and you'll note on your screen the different amounts that can be claimed, the percentages. So currently, we're dealing with an 100% write-off that will phase out in the future as noted on your slides. But again, this is a really great opportunity to use it while you can. In addition to the changes in the percentages, which were made by the new law, one of the key changes, and I think one of the biggies for all of us, is that it now applies to both new and pre-owned property. In the past, it only applied to new property. So if you bought reconditioned machinery, you could not use bonus depreciation, but now you can. And it also applies to certain film, TV, and theatrical production costs, which is something new. Yeah, I know that's kind of a limited thing. The key here is for the new as well as the used property. As you may be familiar, we know that vehicles are kind of a machinery and equipment, but there are special rules in the tax law that limit what you can write off, or rather really impact the timing of when you can take your write-offs. And for vehicles, there's a dollar limit on what you can write off each year. And for vehicles placed in service in 2018, it's going to be up to $18,000, new or used, because for bonus depreciation. It will only be $10,000 if you elect not to use bonus depreciation. You can see the succeeding year dollar limits. Now, I want to point out that in the past, there used to be different dollar limits for passenger vehicles, which we're all familiar with, as well as light trucks and vans. Light trucks and vans used to have a different, slightly higher limit. For 2018, they're going to be the same as for the passenger car. So the numbers on your screen are what's going to apply for a vehicle used for business, whether it's a car or a panel truck or something like that. Going forward, starting in 2019, because the dollar limits can be adjusted for inflation, and many of the numbers you'll see as we go through, like the first-year expensing, will also be adjusted for inflation. Because of the inflation adjustments, there may wind up being different numbers for light trucks and vans versus passenger cars in the future. But for now, these are the numbers we're dealing with, and these can impact decisions about which vehicles a business will purchase based on a business's needs and the tax incentives. So another tax incentive, or a special rule, if you will, has to do with heavy SUVs. So vehicles that are essentially heavier, and they're not subject to the dollar limits I just talked about earlier. You can use first-year expensing up to $25,000, and you can use bonus depreciation. So essentially, buying a heavy SUV in 2018, you're going to be able to write off the cost. And so businesses making the decision now, because of the tax incentive here, it may be less costly to buy a more expensive vehicle. I know that's counterintuitive, but that's how the tax rules interplay with your business decisions. I think the key point here to keep in mind is that the tax breaks I've just talked about for equipment purchases, vehicles, and such, the qualified improvement property, The tax breaks apply whether you pay for them or finance them, pay for them in cash or finance them in whole or in part. And so that's a significant thing, meaning you don't have to have the cash on hand to take advantage of upgrading what your company owns, what goes on its balance sheet, and the tax breaks you can claim. Now, BBVA Compass, Charles will be talking more about this aspect later on in the program, so I'm not going to go into this further, but I just want you to keep this in the back of your mind, that the financing aspect of equipment purchases is really essential. Now I want to move on to another aspect of the new law, which are changes that impact your payroll. And this happens in a number of ways. First of all, it impacts what you have to withhold from employees' paychecks. As you may know by now, the IRS has confirmed that you don't have to have employees complete new W-4s to be able to figure their withholding. It's based on what they've already submitted to you as employers. So the new withholding tables are out. If you have a business, you should have implemented the new withholding tables, but you want to be sure that the payments that you deposit for employer taxes and withholding from employee wages reflect the changes in the tax rates for individuals and therefore the required withholding amounts. Now, again, as I mentioned earlier, I ran through rather quickly the lower tax rate brackets for individuals, and this translates into more take-home pay for most employees. And that, again, is something that's reflected in withholding. But going beyond this, there are other rates that you should be aware of besides just straight withholding. So for employers that pay supplemental wages, meaning bonuses, commissions, severance pay, awards, back pay, these kinds of extras, if you're not going to add it to the regular wages and figure withholding on the whole thing, and you're going to just do a separate withholding on the supplemental wages, there's a new tax rate. It's 22%. So that's something to keep in mind and to change your payroll practices accordingly. Of course, I just have to mention for purposes of being technical that if supplemental wages are more than $1 million, which likely doesn't impact most small businesses, there's a 37% flat rate for withholding on supplemental wages. Another thing that's changed for payroll is that for 2018 and 2019, there's a brand new tax credit. It's a credit for employers that continue to pay wages to employees who take family and medical leave. Now, as you probably know, there is no federal law requiring employers to continue wages while employees take family and medical leave. And in fact, only very small employers don't even have to offer the leave. Larger employers under the Family and Medical Leave Act have to offer the 12 weeks of unpaid leave, but again, they don't have to make payments. There may be state laws requiring some pay, but anyway, the point here is that there is a brand new credit for companies that choose to pay some or all of the wages while their employees are on this family or medical leave. And the amount of the credit, and a tax credit, as you know, is more valuable than a deduction because it reduces your tax bill dollar for dollar. So it's really a great tax break. It's a sliding scale depending on the amount of wages you continue to pay. And it only applies to basically rank and file employees, those earning less than $72,000 a year. I think this tax break is kind of an experiment, if you will. Congress is going to monitor this and see how many companies take advantage of it, and I think that perhaps going forward we may see changes not only in the Family and Medical Leave Act, but perhaps a permanent credit for this kind of offering. You know, we all know that we're in an ever-tightening job market. So I think many, if not all, employers at this time are looking at their wage offerings, their benefits offerings, to make sure that they can attract and retain valued employees. And I think in terms of this decision, you have to factor in changes in the tax law. So, for example, a number of employee benefits that companies were able to write off in the past are not deductible anymore. So, for example, if a company paid employee monthly transit passes or free parking, they could write it off. As an aside, employees who get the benefit can continue to exclude it, to treat it as tax-free income. But companies have to decide, do they want to continue offering these benefits even though they may no longer get a tax break? Another example would be reimbursing employees moving expenses. If you have an employee who's relocating across the country, and should you pick up some or all of the tab for moving personal items? And again, it depends on how valuable the employee is and how important offering this break will be, even though the company is not able to deduct it. Another question would be understanding the changes in employee achievement awards. In the past, it was possible to pay cash in certain situations, but that option has been eliminated. So you can't give gift cards or anything that's like cash to an employee as an achievement award. So you have to give property, and it has to be under certain situations and conform to certain rules in the tax law. But the change has to do with the elimination of cash. And as I said at the start of this particular slide, thinking about what other benefits you might want to offer to prospective job applicants as well as to your existing employees. There have been a number of changes in tax deductions. I just went through some of them related to certain benefits that you offer to employees, but that's not the end of the story. For companies that pay, I think we have to have a reexamination of our debt, of our borrowing, whether we want to expand based on borrowing or we want to seek equity or have internal savings to be able to fund our expansion and our growth, because the interest deduction is now limited, meaning that generally you can only deduct 30% of adjusted taxable business income, meaning earnings before interest, taxes, depreciation, and amortization. It's a technical kind of thing, but just think about it. 30% of interest you're going to be limited to that. Now, the good news is that smaller businesses are not subject to this limitation. So businesses with average annual gross receipts in the 3 prior years of $25 million or less, you can continue to deduct you can continue to deduct 100% of your interest. But again, businesses that grow can easily get large enough to exceed this gross income threshold, gross receipts threshold.
Barbara.
Yes?
Jacqueline had one quick question I wanted to interject here.
Sure.
She asks, does this apply to sign-on bonus also?
Does what apply? Sign-on bonus. This sign-on bonus is not an interest expense. So sign-on bonus has to do with payroll and withholding on that.
Okay. I apologize. I think it was for that previous slide.
Okay. I hope.
Sorry about that.
We can circle back at the end if there's time. I hope there will be time. Just want to. I perhaps sound like I'm running through this rather quickly, and that is true because there's a lot that I just want to raise awareness about so that you kind of have familiarity with these rules and you can discuss them with your tax advisor. So the deduction for entertainment costs, that's gone. No more. You can't take a client to a ball game anymore. No deduction for that. You can certainly continue to do it, but it's not going to be a deductible expense for tax purposes. Now, there is an open question about, well, if you take a customer to lunch, is that an entertainment cost? And the answer for that is, I can't tell you because we don't really know. We need IRS guidance on this. Another deduction change is the elimination of the domestic production activities deduction, which formerly allowed businesses to take a write-off if they produce things in the U.S. So that's gone. Another change has to do with the net operating losses. Basically, for most businesses, you're no longer going to be able to take any carryback. You will be able to carry forward your losses, and instead of a 20-year limit, it can be indefinite. So that's something to consider. And another aspect of change in the net operating loss rules is that the amount of the loss that you can use in going forward is limited to 80% of your taxable income, rather than, as it was up till now, 100% of your taxable income. Other changes, I'm going to kind of gloss over this here because A, they're kind of boring to talk about, and B, they're kind of technical. So just to note that there are changes in accounting rules that make it easier for smaller businesses to operate, more intuitive, less record keeping, less complexity at tax time. So these are rules that you might want to discuss with your tax advisor. As promised at the start, I did want to point out what hasn't changed, because while the new rules are sweeping, they don't get rid of all of the old rules. So, for example, the rules for retirement plans are largely unchanged. So you continue to be able to offer your 401k plans and such, and however we've been operating before, we can continue going forward. Also, with respect to tax credits, most of them have remained unchanged. I did note for you a new tax credit, but we have, for example, the research credit, the work opportunity credit. These continue to apply, and I think we have to take advantage of the credits that we're eligible for. General deductibility for most expenses, ordinary and necessary business expenses that don't have specific classifications or special rules in the tax law, they continue to be deductible. So, for example, credit reporting agency fees are a business expense that you can continue to deduct. So if you get business credit reports from Experian, that cost is deductible. If a business, if you have accounts receivable that if you have invoiced for goods and you are not paid and you report on the accrual method of accounting, you may be able to claim a bad debt deduction, and that will be another write-off for you. So again, you have to determine whether this kind of expenditure is still deductible. Likely, if you've been deducting these items in the past, you will continue to deduct them going forward. If you're looking for a new tax return preparer, just a little tip for you. I think it's a great idea to verify the preparer's business before you hire, and you can do this by checking the tax preparer's business credit report, which, as I pointed out, you'll be able to write off. So Experian can be of a help to you here, not only in checking for who you want to do business with, but also the preparer that you use. I'd kind of like to wrap up my portion of the program here with a couple of remarks. And Gary talked about this at the beginning, that the information I've presented here is general. It's to give you a heads up about some of the changes or what hasn't changed, but every business situation is unique, and you need to talk to your tax advisor to determine which breaks you qualify for, what you need to do to nail down write-offs and such. And it really would be a good idea to meet with your tax advisor as soon as possible so that you can look forward to 2018 and determine what kind of business decisions you want to make in light of the new tax law. I think it's also vital that you determine, I've been talking about federal taxes, but you have to also look at the impact of state income taxes, because in many situations, the rules are different under state law versus federal law. For example, some states do not have conformity when it comes to the Section 179 first-year expensing deduction I talked about earlier, bonus depreciation that I talked about earlier. While these may be wonderful new breaks on the federal level, they may not be available on the state level. And again, they may impact your business decisions about actions you do or do not want to take. Another thing to be on the lookout for is guidance from the IRS. There's an awful lot that we don't know. The new law was so extensive and introduced many new concepts that tax specialists do not fully understand and are awaiting guidance from the IRS. The IRS each year has a priority guidance list, and they've just updated it for the second quarter of 2018. It's the 2017-2018 priority guidance list, and they added a brand new Part 1 to cover more than a dozen questions regarding the Tax Cuts and Jobs Act. And this when the guidance will be forthcoming from the IRS, I don't know. It's a good question, and we'll have to await additional information from the IRS. The IRS has created a new landing page where it plans to post guidance related to the new law and the changes. But again, will we get anything immediately? I don't think so, but especially with respect to the new 20% qualified business deduction, I know the AICPA, which is the National Organization for Accountants, has asked the IRS to expedite guidance on this because we all want to know about it. For business owners, it's essential that we know about it because we have to pay, if we own pass-through entities, we're paying estimated taxes. And the first estimated tax payment for 2018 is April 17th this year. So be on the lookout, monitor the guidance from the IRS, and also look for additional legislative changes. For example, as part of the Bipartisan Budget Act, Congress extended dozens of provisions that had expired at the end of 2016. They extended them for 2017, but we don't know if they're going to be extended again for 2018. And some of the provisions that impact individuals, some of these extenders impact businesses. Again, bottom line here is stay alert to changes. So just to sum up before I pass off the program, be sure to work with your tax advisor and look what's happening from the IRS and Congress. And thank you so much. And at this time, I want to pass off the program to Charles McCombs.
Thank you, Barbara, and thank you, Experian, for allowing BBVA Compass to be a part of this program today. Barbara, fantastic job, great comments and insights, and I know everyone learned a lot today on this presentation. One of the areas that Barbara highlighted was Section 179, which allows for expense deductions up to $1 million for the first year. So 2018 is a fantastic time for small businesses to be investing in new equipment. And BBVA Compass Bank would very much like to assist you with that. In most cases, when people purchase equipment, they they get one loan each time they purchase a piece of equipment. BBVA Compass has a unique product that allows us to set up a line of credit for you to purchase multiple pieces of equipment throughout a 12-month period. This allows you come to the bank one time, you apply for the loan, and we would set up a line of credit in an amount between $100,000 and up to $1 million. Then throughout the period of 12 months, you can, as you purchase equipment, we would advance funds on that line of credit, and then we would set up a loan each time you advance for a term of 5 years. The rate would be tied to variable rate of prime, and there is no prepayment penalty if your business does well and you would like to prepay it early. In order to apply for this product, all you would need to do is give us a completed application with a 4506T form, 2 years of personal and business tax returns, year-to-date interim statements, and a personal financial statement. Now, as you can see at the bottom of this page, there is an email address, smallbusinessleads.us@bbva.com. If you are interested in discussing this further with us, just send us an email with the name of your business, your name, the type of loan or the amount that you would be interested in, and we will have someone contact you within 24 hours. Again, we're very excited about this product. We use it for a lot of our small business clients who have multiple purchases throughout the year. The other topic that I would like to discuss briefly that Barbara mentioned was payroll. We understand that small business owners wear a lot of hats and have a lot to do throughout the day. And one issue you don't want to have to be concerned about is payroll, paying it on time, what are the laws, et cetera. You don't have time to look that up. So BBVA Compass offers a payroll service powered by ExecuPay. We have two different types. One is the Express and one is Express Plus. As you can see on the left-hand side, the Express offers online payroll, which is a securely run payroll anytime from any device. It also gives you the tax service, which is pay and file your taxes electronically. It allows for employee access, which employees can retrieve their pay stubs and W-2s via their computer or smartphone. We give you email notification to remind you to process your payroll. There's also direct deposit capabilities, an ACA monitor, which helps you navigate the Affordable Care Act, ensuring you know exactly where you stand and that you are compliant. And finally, there's an HR 360 library, which gives you access to HR information at your fingertips, like rules, laws, sample policies, handbooks, and job descriptions. If you would like the Express Plus, you get all of those features plus the employee time and attendance, which is automates your time tracking, allowing employees to clock in and out from any computer or device, and reduces the data entry at payroll time. There's also an employee hub, which is actually an intranet for your employees, which allows them to clock in or out, request time off, receive pay stubs, and even share messages and documents. There's an employer text notifications, which we would send you text reminders to process your payroll and message you after payroll for items like requiring a bank deposit. We would remind you to make your bank deposit. And then finally, there's the employee text notifications, which they can receive information regarding their direct deposit via text, such as what is their net pay, how much is their time off balance. So that's a great service that we offer. If you would like to take advantage of this, you would just need to contact us at 1-877-563-0718. And for participating in today's webinar, we are giving you a special, whoops, it went back twice. We are offering, going to discount $150 for webinar attendees only today. So if you call that number before March 31st, you tell the sales rep you are part of the business banking webinar with BBVA Compass and Experian, the representative will be able to look it up, see that you attended, and they would give you $150 off the cost of the service, which would be prorated each month at $12.50. So again, Gary and Barbara, we're very excited to participate with you today. We look forward to participating with you more in the future, and thank you everyone for joining, and I'll turn it back to Gary. Thank you.
Okay, thank you so much, Charles. And we've got time for a few questions that came in. I'll try and get through a few of these. Greg, this is a tax question from Greg, and Greg writes, I've been told that fair market leases are expensed are also to be put on the balance sheet as long-term debt. When payment is made, the entry is cash and the expense. What is the best place to put the offset for the note reduction?
I have no idea. That's a question that's beyond my expertise. I'm totally unfamiliar with those kinds of leases, so I'll have to pass on that. But I did see that Gary, we did have a number of questions regarding service businesses.
Yes.
What is a service business with respect to the 20% qualified business deduction, and that's been quite an issue for many of us, trying to decide what businesses fall into this category and what does it mean. So maybe I can just answer that briefly, which is that if you are what's termed a service business here, and your income is over a certain amount, you're not going to be able to get any kind of any portion of the 20% deduction. It's not going to work for you. You're out of luck. So basically, it's the kinds of service businesses that we're familiar with: accounting, athletics, law, health, financial services, consulting. One of the catchphrases that was added in the law, it's any business that involves the performance of services where the principal asset is the reputation or skill of one or more of its employees or owners. So basically, I mean, you could argue any business falls under that cap. That's one of the areas where we're really needing IRS guidance. So the bottom line is, if you're an accountant or a lawyer or a consultant, you know that you're falling under this category. But if you're in another kind of business, we're not so sure, and that's where we need the IRS guidance.
Okay, good answer. Okay, did you see that there were a few other questions in there, Barbara? There was one about forming, the gentleman Jonathan had asked about forming a small LLC, and he's considering filing taxes as a C Corp because, as I understand it, I can write off all health insurance for my family, and as well as employees. To do this, I have to sign up with BASE, the HRA wrap. Will this save me money?
It's a great question. I think many business owners these days are wondering, what's the best type of entity to use? Should I be a C corporation? Should I be an S corporation? Should I be, as you point out, an LLC that elects to be taxed as a C corporation, which you can make this election? The question is not easy, and it's not exclusively a tax answer. In other words, you have to factor in more than just what it's going to mean for your income taxes, what it's going to mean as Jonathan questions, your ability to write off all of your health insurance as a business expense. For example, if you want to perhaps expand your business through equity crowdfunding, then you have to be a C corporation, because you can't be an S corporation with limited number of shareholders, and you have to be able to offer stock. And so the point is that it's a very complex decision. It shouldn't be made based on one factor alone, and I think you need to sit down with both a legal and a tax advisor to make the decision.
Okay. Excellent. Well, I think we're going to have to leave it there, folks. I hope you found this webinar useful and informative. I certainly did, and we would like to thank everyone for attending today's session. Thanks to Charles McCombs and Barbara Weltman from Big Ideas for Small Business and presenting this valuable business tax information to us. Look for a follow-up email from BBVA and Experian with details of today's offers, and a link, of course, to the recording and the slides. When you exit the webinar, you will be sent to a short 3-question survey. We'd really appreciate your responses to this. It really helps us create good, informative webinars and really help improve our program. So we would appreciate it if you could just take a moment to do that. And with that, I'd like to wish you all a very good day, and thank you for attending.